GST does not apply to the purchase and sale of residential properties, except, and it's these exceptions that can cost you hundreds of thousands of dollars if you get it wrong. Hi, I'm Jeff Banks from MW Lomax, and this is the Banks Report. In my practice, I help people who are working hard and using property and self-employment to help them reach their financial goals. So when is GST applicable to the sale of a residential property? The legislation says GST is payable at the first sale of a residential property and also applies to the sale of a substantially renovated property. Okay, so I buy a newly built house as a first home buyer. What does that mean to me, the buyer? Not a real lot. The GST is included in the price and the vendor has to deal with it. Similarly, if I buy a house that has been substantially renovated, the same applies. Here, I am talking to those out there looking to make either a little or a lot by target property transactions. Keeping it simple, buying the worst house in the street, cosmetically renovating it and selling it for a profit, or flipping houses, would generally not attract a GST implication at sale under the residential housing provisions of the tax law. It also means that all direct expenses are not GST claimable either, regardless of whether the entity or person doing the renovations are registered for GST. You need to quarantine these expenses in that case and not claim the GST inputs. Having said that, those applying a takeover strategy to the same type of transaction where the business person never actually owns the target property, because they are not the owner of the property, are not engaging in the purchase and sale of residential property, but merely providing a service to the owner, most certainly are subject to GST provisions, and their share of the profit they derive from the sale will have a GST implication, as will the costs they incurred in making it happen. Confused yet? It gets worse. There are rules around registration requirements that can throw a spanner in the works as well. There is also the margin scheme, which manages to confuse people even more. You want to hear a scary story? Say Mr. and Mrs. Smith, names changed for privacy purposes of course, bought a house on a large block of land and they lived in it for some time, long enough for it to be considered their principal place of residence. One day, they decide to cut the block in two and sell off the vacant block. In a normal sense, at a private person point of view, Mr. and Mrs. Smith are not engaged in business and as such do not have to be registered for GST, but the subdivision has created two new assets. What was 26 Smith Street has become 26A and 26B Smith Street. In our opinion, there is potentially not a GST issue for them, but Mr. and Mrs. Smith, once the subdivision has been approved, decided to build on the vacant block whilst living in the front. Then, once the house was built, knock down the existing house and build another one. Would you not suggest there has been a little entrepreneurial intent here? So, when is GST applicable here and to what extent? 1/11 of the sale price, and what if I live in the back for an extended period of time whilst renting the other property? So many potential questions and lots of interpretations and strategies to consider. Not the place for a 5-minute video. GST and property, particularly residential property, can be a minefield waiting to explode in your face. Our experts are well versed in GST as it applies to these types of transactions. Contacting MW Lomax at compliance@mwlomax.com.au or your client account manager can be the first step in ensuring GST does not destroy your financial dreams.